Home Depot reported their third quarter results before the markets opened. We'll come in here, take a look at the numbers, the guidance, and as always, take a look at the stock chart. Home Depot has been consolidating for over a year. We'll see where this one can be a buying opportunity. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would mean a lot. Ticker symbol HD. Home Depot reported their third quarter results. Year to date, this stock is down nearly 4%, and over the past 1 year has gone basically nowhere, down just 1%. Now, they did report their third quarter results, sales coming in at $37.7 billion. That was down 3% year over year. Keep in mind, Home Depot is a company that's very dependent on the US housing market. And so as interest rates have skyrocketed over the past 1 year, new home sales and home construction have declined substantially, as well as mortgage rates being higher over time. That has certainly hurt Home Depot's top line sales. And so while interest rates remain high, while new home sales and home renovation remains low, that Home Depot top line will continue to likely see declines year over year. Now, their net earnings for this Q3 coming in at $3.8 billion or $3.81 per diluted share. That beat estimates over on Wall Street by roughly 4 to 5 cents, as estimates were closer to 376 on that EPS line. And so Home Depot doing a good job controlling costs where they can, at least. But although those net incomes did beat, that was down year over year, as a year ago we were sitting at $4.24 on that EPS line. Now, in terms of guidance, they did say sales for this full year 2023 will decline between 3 and 4%. Operating margins expected to come in at 14.2%. And then the big thing is that this interest expense, this really stands out to me, as they estimate interest expense of approximately $1.8 billion for this full fiscal year. And that is a big number. We'll come over to take a look at their assets and balance sheet, and we'll see that is a big expense line over at Home Depot. And then diluted EPS expected to decline between 9 and 11% for the full year. You see estimates over on Wall Street, they expect EPS to decline 9% year over year, sales to decline roughly 3% year over year, and then for the next 3 years, sales to basically remain flat to just slightly up. And so Home Depot will certainly have to figure out how they want to accelerate growth on their top line, at least while home sales remain low. That will continue to be a challenge for Home Depot. Certainly they can probably pull more levers on their bottom line. Now, taking a look at their consolidated statement of income, we have that net sales of $37 billion. That was down 3%. Cost of sales came in at $24.9 billion. That was also down roughly 2.6%. But if your sales decline faster than your cost of sales, your gross profits will still go down nearly 3.7%, down to just $12.7 billion. Last year we were sitting at $13.2 billion. We had the 9 months ended on the right hand side. You see on a 9-month picture, basically paints the exact same picture. Your sales are down 3% on a 9 months basis, and then your gross profits are down 3.4% as well. Now, on the operating expenses, those continue to rise over at Home Depot. You see sales general administrative, that rose 3% year over year at $6.6 billion. And then you have depreciation and amortization, a much smaller expense, but that was up nearly 12% year over year. And so your total operating expenses did rise 3.6%, even though your sales declined at 3%. And so your operating income, will come down to $5.4 billion. Same time last year, we were sitting at $6.1 billion. That is a decline of 12.1% year over year. This quarter was particularly worse for Home Depot. As you see on a 9 months basis, their operating income is down 9%, but then this quarter was down nearly 12%. So this quarter proving to be a bit more challenging over at Home Depot, especially considering their SG&A continuing to go up by nearly 3%. Now, in terms of interest expense, Home Depot does pay a decent amount of interest expense. They have a lot of debt, which we'll look at. And this is the interest that they're paying on that. On a 3-month basis, they paid out nearly $500 million worth of interest expense. On a 9-month basis, they're sitting at $1.4 billion worth of interest expense. That is up 22% year over year. So higher interest rates certainly hurting Home Depot's bottom line. And speaking of their bottom line, net earnings coming in at $3.8 billion. That is down 12% year over year. And EPS coming in at a $3.81 number. Last year we were at $4.24. So all things considered, look, Home Depot is struggling to maintain growth on their top line. In fact, they're seeing declines on their top line, and then they can't really pull too many levers, controlling costs on that OPEX side, controlling interest expenses. So their bottom line is really hurting just because they aren't able to grow their top line as fast as they would like to. So this just shows in a time where the Fed is increasing interest rates so rapidly, that does hurt a company like Home Depot that's directly dependent on the housing market substantially. That certainly hurts a company like Home Depot a lot. Now, moving on to their balance sheet, they do have roughly $2 billion worth of cash and cash equivalents. That's down roughly $500 million from same time last year, where we were closer to $2.5 billion. Now, the majority of their assets are actually tied into merchandise inventories and then property, plant, and equipment. You see $22.8 billion worth of inventory on $30.6 billion worth of current assets, and then another $25.7 billion worth of property, plant, and equipment is what's on their assets. And so really on a quick ratio basis, Home Depot isn't looking that good. They don't have a ton of current assets. If they had to pay off an account or pay off a big cash expense in the near future, that would actually cause troubles over at Home Depot, as they're just sitting on $2 billion worth of cash and $3.9 billion worth of receivables. So again, not a lot of current assets over at Home Depot. Then to make matters worse, they do have a substantial amount of liabilities, nearly $11.4 billion worth of accounts payable, and then another $7.6 billion worth of current liabilities. That brings our total current liabilities at $23.5 billion, and then nearly $40.5 billion worth of long-term debt. That is what is causing their interest expense to really be so large. At nearly $1.8 billion worth of interest expense for the full year is what they're projecting. That is a lot of money, considering that they just generated nearly $3.8 billion worth of net income in 3 months. They expect to pay nearly $1.8 billion in interest expense for the full year. That is a big portion of their bottom line. So if Home Depot can come in here and pay off this portion of their long-term debt, that will certainly help their interest expense, and then that can likely bolster on more cash onto their balance sheet. Really, their balance sheet doesn't look great in my opinion. They are sitting on a lot of debt and not enough cash, and so this balance sheet should be a concern for investors over at Home Depot. Now, in terms of cash flows, this company is still looking quite strong on a cash flow basis. We have $12.3 billion worth of net income on a 9-month basis. We get to add back some depreciation, stock-based compensation. We get to cash flows of $16.4 billion in just 9 months. Very strong on a cash flow basis. You see, last year we were at $10 billion, but they did experience a $6.5 billion one-time changes in working capital expense. And so this is really more close to their net cash provided by operating activities of close to $16.4 billion. Now, they do spend nearly $3 billion of that on investing activities, most of it on their CapEx, and then they do spend nearly $6.5 billion in 9 months on the repurchase of common stock. This is a bit puzzling for me, considering they have so much debt on their balance sheet. They only paid back $1.2 billion worth of long-term debt in this most recent 9 months. I think Home Depot can kind of switch these numbers around. If they continue to pay off more debt, I think that would bode well for their income statement, considering they would pay less interest expense. In my opinion, for a stock that's not really gone down all that much, in my opinion, they're buying back a bit too much stock when they can be paying off long-term debt. And I think that is something I would prefer if I was a shareholder over at Home Depot. They did use roughly $13.9 billion in financing activities, and so their cash and cash equivalents did decline down from 2.7 down to $2 billion at the end of these 9 months. They do also pay nearly $6.3 billion in cash dividends. You see, Home Depot is a cash dividend grower. Back in 2012, they had an annual dividend roughly $1.16. Now it's gone up to $7.60. And keep in mind, they just did a quarter where they posted EPS of close to $3.81. So that is a payout ratio, I believe roughly 50%. Close to exactly 50%. And so that payout ratio over at Home Depot getting close to 50% as they continue to increase their dividends year in, year out. Taking a look at the technical charts for Home Depot, in my opinion, a fairly simple chart to really look at. They have a big level of support at close to $270 per share. This is a level where the stock has found support back in August and September of 2020, and then has retested that level numerous times back in 2022, and then even close to in 2023. And so that level at $270 is really a strong level of support. Below that, I think a second level of support would be near $247, we'll call it, even down to $245. And so this range is really where I would be interested in coming in and accumulating shares of Home Depot. Now, they do have a level of resistance up at $330. That is a strong level of resistance for Home Depot that has, again, acted as resistance numerous times back in 2022 and 2023. And so if Home Depot does come in here and this rally does continue on its way up and it crosses over this $335 range, there's a good chance Home Depot comes up and retests these all-time highs back in the 400s, believe it or not. And so if you were a swing trader, you could possibly come in here and play Home Depot on a breakout above $333 per share, possibly all the way up to close to $400. My guess would be that Home Depot comes up here and gets rejected, only to come back down to this $270 per share level. This stock has been on a extremely strong rally over the past decade, and really over the last 3 to 4 years has taken a breather, just consolidating between 270 up to 330, and it's been making this very simple consolidation pattern for almost 4 years now. I don't see any reason why it would break out of it, at least in the near future, while their sales remain muted, while growth over at Home Depot certainly isn't great. I would expect the stock to remain in this sideways pattern, and really any break below 270 all the way down to 250 I think can be a good point where you can come in here, maybe pick up a few shares of Home Depot. This stock is similar to a FedEx, where I think it has good prospects in the future, not great growth, but I think good prospects on that dividend side. At least they are a dividend payer and continue to raise that dividend year in, year out. This is a stock you can probably hold for a long time. My only concern with Home Depot is their balance sheet. This is something they have to improve. I think the management should consider possibly paying off more debt rather than continuing to do more and more share buybacks, especially considering their stock is closer to a 52-week high, in my opinion, than a 52-week low. So that is something to consider over at Home Depot. That was my take on Home Depot stock, ticker symbol HD. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.